Debt is one of the two sources of financing that we talked about before. That if a company is looking to finance externally, they really only have two options. They can go out and take debt, which is borrowing money, or they can take equity, which is attracting new investors in the company. So we're going to talk about debt today, and there is two different types of debt. There's you can take the traditional bank loan, go to the bank, borrow some money, which everyone understands, or you can, as a company, issue bonds. And most textbooks tend to focus on the issuing of bonds, even though it's more limited. Like if you think about a bank loan, it's something that a larger number of companies can get. Large, small, mid-sized companies are all available to get bank loans. Some small companies can get it if they provide collateral and security, but most small companies, startups tend to go to equity because they don't have the history. Bonds, however, are limited to a very small sector of companies. So that would be large public companies would have access to issuing bonds as a source of debt. However, the concept of the two is very, very similar. There's a couple of benefits. So why wouldn't large companies just go to the bank? Because they can, and they do. One is bonds are flexible. You can set up your own terms in a bond, how long you want to issue the bond for, the term of the loan, things like that. You also traditionally, a lot of bonds just pay the interest only, as opposed to having a principal and interest payment. So it makes it less expensive in terms of the monthly payments from a cash flow perspective. And then the third thing is bonds are marketed towards investors rather than applying for a bank loan, which is why public companies are really the only source of the only types of companies that can do that. So if we step back and then think about the pros and cons of debt as a whole, whether you do it through a bank loan or through a bond, the biggest benefit or the biggest pro for debt is that it's cheaper than equity. Equity is you are giving away a piece of the company. You're not giving it away, but you're selling it. So the remaining shareholders will own a smaller percentage, and you're essentially you're foregoing all of the profits that you're going to get in the future as well. So you're sharing dividing up all your future profits if you issue equity, and you're not doing that with debt. You're just agreeing to make an interest payment. So it's significantly cheaper. And then secondly, it gets even more cheaper when you consider the fact that interest is tax deductible. So you can write it off, which is not the case with equity. Dividend payments are not tax deductible. The negatives. So then why not just issue debt? It's cheaper, deductible. The biggest problem is bankruptcy. Debt holders can cause bankruptcy. So if you borrow money from the bank and you're unable to pay it, they will force you into bankruptcy. Equity shareholders will never force you into bankruptcy. They can fire the management team and get angry, but they are the company, so they're not going to bankrupt the company. So that is the biggest risk with debt. You don't want to constantly be looking over your shoulder to see if you're going to go into bankruptcy. Now, if you think, okay, well, that's not really a concern, it still does introduce fixed payments. So now you've got monthly payments, or probably not monthly. With bonds, it's usually a semi-annual, but whatever. There's a certain set period of time where you need to make the payment, interest, and that puts pressure on you. Dividends for a corporation are optional for common shares. So that's the benefit of equity from that point of view. And then there's also a certain amount of risk associated with the company when the debt percentage increases. So if you're 60, 70% financed by debt, you've got heavy fixed payments, and also you're getting closer to the bankruptcy situation. You may not be bankrupt, but because you have such a high level of debt, your interest rates are higher if you ever choose to borrow money again, because your credit rating is not as good.